taking profit, in my opinion, can be a neglected or glossed over topic when it comes to talking about or teaching Forex trading strategies. But I personally do not consider any strategy a full strategy without rules regarding how to consistently take profit, which is also known as scaling out. Most traders have an exit plan in place for when they are in losing trades, but scaling out is your exit plan for when you are in winning trades. And without it, you will deplete your trading capital and you'll feel chronically frustrated when you see your profits vanish again and again. So let's chat about this now so that you are not one of the traders who ignore this critical aspect of a profitable trading strategy. When you scale out of a trade, you are taking a portion of your trade that is currently in profit off the table and putting it into your pocket. And scaling out is a must. This is one area, though, that I really cannot help you besides maybe give you some numbers and some options to think about and see really what fits your comfort level, your relationship with money, and your own personal trading psychology. And know that there is no wrong way to scale out, only that you do it and that you protect your capital. So I'm going to share a couple of different methods, again, that are kind of popular for scaling out. You can develop your own. I'm going to kind of throw some numbers out there just to kind of get your brain working. But again, customize that as per what feels good to you. In this first example, we're going to talk about just a projected target level. And one way to scale out is, if you used any basic technical analysis method, we covered several of them in our trading basics unit, that creates a target. And then you take profits at, again, consistent levels, and those consistent levels can be like a percentage of the move or a certain number of pips as price travels to that target that you've established. In this example here, in this graphic, you see that we have established that this level right here is our target. And we're taking that from structure and we're just saying, hey, this is going to be our target. Right now, your entry is right here. So you're at this candle right here and you don't really know any of this yet. None of this has actually happened. All you know is that whatever your signal is, you just got it. And so you're entering price right here on this entry line. And you've established where your target is, that it's here. And what you can take from that is that if you measure this entire move, if you just take 50% of that target, in this case, it's a percentage move, 50% of that target is that you could essentially scale out or take a portion of your trade off when price hits this level. And if you see right here, price, you have your entry here, price pushes straight up right here, and you hit that 50% mark. And so, in this example, you would take 50% off your trade and you leave 50% running until you hit your exit point or your target, and then you're exiting with the remainder 50%. And again, those can be any numbers. I'm just trying to, kind of give you some examples. So that is if you're using a projected target level. Another way is using the Fibonacci retracement tool or the Fibonacci extension tool. We touched on this earlier in Unit 5 when I talked about Fibonacci trading, and I shared my method of using fibs for your taking profits. And I do have a course that is fully fleshed out and puts all of my confluences and all of my, dialed in trade management there. So you may want to check that out. But even just in a general sense, it's worth a second mention in this course here because it is a very popular trade management strategy. And in using the fibs for take profits, you can obviously change the levels to reflect any size move that you want and one that fits your strategy. And you also have control over the amount of your trade that you're taking off the table, meaning just like you're seeing here, you could take off 70% and then 20 and then 10. You could do 50-50 like we just showed you, you could do 50, 25, 25. There's, again, no right or wrong. So you have control over that, but make the fib work for you. Even if you're not trading with fibs, you can use them to manage your levels just by measuring the swing. And I'll have several videos on that. And like I said, my course really dives into that because I love using fibs for managing, take profits and stop losses, and for trade management. It works so well for that. So make your fib work for you and for your tested strategy. And so if we look here just at graphic 1 right here, what you're going to see is we have the swing that starts here, right here at the bottom. And this is the top of the swing. And I know there's a lot of stuff that's kind of condensed on this graphic, so it may be a little bit hard to see. But this right here is actually the swing in this graphic. And you don't know yet that any of this has happened. And so once that swing is measured and then price makes its way back down here, we are saying in this graphic that our entry was right here. Once price, hit, which, if you looked at some of my last units, this is the golden zone, and this is where I look for entries, and we're looking at the entry here on the 618. So we're looking at that bounce, and we're saying in this graphic, this was our entry right here. This is our stop loss right here. And if you look at these fib levels of the 23.6, of the 0, and of the negative 23.6 that I've got marked here on this fib, you have take profit 1 that hits right here. And so at take profit 1, you might, in this example, take 70% of your trade off the table. And then price pushes up and it pushes back down, and price comes up and it hits take profit 2. And at take profit 2, you may take 20% off. So now you've got 90% profit that you've secured, that you're protecting your capital, and you have 10% of your original trade that's still running. And that goes in this example to take profit 3, and maybe you're closing it down, closing the trade down at take profit 3 when you take that 10% off the table. Here in graphic 2, you got a little bit of a different example where we still have the fib that's being drawn from this bottom candle to the swing right here at the top candle. So this is your original swing, and you don't know any of this has happened yet. And what happens is, price comes back down, hits down in here into the golden zone, and you have your entry that is right here. Now, in this case, you may want a smaller take profit, than we had in the first graphic. Your take profit was this, this many pips. And let's say that this is, 80 pips, but we may say, no, we like taking our first take profit pretty quick. I like to take 40 pips right off the gate. I've just found that makes me a lot more successful and gives me a higher win rate, helps me protect my capital. So in this case, because you take it earlier and more often, even though your trades sometimes run, you have an entry here, and right here, you may at the 50%, you may take your first take profit. And in this, you may take 50% of your original trade amount. And that could be, 40 pips. It depends on what pair you're trading and what time frame. I mean, that could be 100 pips. It could also be 12 pips, but regardless, in this example, you're taking this early take profit. And so you might take less off the table. Then price travels up, it pushes back down, and it hits your second take profit. And in this example, you may have take 25% off the table and set a trailing stop loss and a runner, and basically say, I don't know when I'm exiting. I'm just going to exit when price falls back a certain number of pips, and price does fall back a little bit, doesn't hit your trailing stop loss, pushes up, does beautifully, but it falls, and let's just say that this hits your stop loss, and so the trade automatically closes that remaining 25%. And so in this case, you really only had like 2 take profits and then an exit rule. And once that exit rule, was hit, and we had a section on how to exit, a lot of options on how to create your exit signal. So we're saying that the trade did exit at this candle right here, that some signal was hit and we closed and took our remaining 25% off. And so that kind of managed that trade with the fibs. It's worth playing with. I love the fib extension tool when I'm not trading with the fib retracement. And I love the fib retracement tool. I use them exactly the same to manage the take profits. But you can have 4 take profits. You can have 5. You can have 1, you can have 2. You know, there's no hard and fast rule. And again, I'm just throwing out some numbers, you know, randomly here of how you would manage to take profits, you know, if you were to use the fibs for managing your trades in that way. Another method for managing take profit levels could be using market swing levels, which can be past support and resistance or price tops and bottoms or some other market structure as the framework for what your rules say is the best way for you to manage scaling out. In this example, what we have was that price traveled down and then pushed back up to hit our level of entry. We apparently had an entry signal. Our setup was good. All of our confluences were in line. So we decided to take an entry. And this is a very popular way of managing, you know, take profit levels and exit levels, is that you're using past structure levels here of things that happened in the past as, you know, to manage where you're going to look to take profit. And I would say that you always want to go a little bit below, you know, where that level actually, where that candle's actually closed or stopped, so that just in case they stop right before the structure, you have already taken profit then, so that just in case price bounces back down, that you've secured profits. But in this example, you know, we see our entry, we got triggered into a trade right here. We placed our stop loss here. Price moved up and we see that it breaks structure right here. And so we're taking profits. Soon as price hits here, we're taking a certain percentage. In this particular case, we took 80% off on our take profit 1. Price retraces, comes up a little bit, and hits take profit 2 right here. And we've set take profit 2 here at this structure level where price breaks through this, or right before it does. And at take profit 2, we take 10% off. And then we have price travels up and it retraces back down a good ways. And then it travels back up and it does hit take profit 3. And how you handle that, you know, we're seeing that price did break this structure, and you may close the trade, close your last 10%. You might have let it run, you know, and price continues to go up. It just depends on how you're managing the trades, but you want to create rules that are consistent and that help you be consistent over and over and over again, so that you execute in the same way and you're not really kind of moved around by, are you feeling confident that day? Are you not? Did you just lose a couple trades so you're scared, you know, so that you're not being consistent with your levels, or you're taking money off the table really fast? Like, you want consistent execution that is not driven by how you feel or intuitive hits. You want tested, you know, and really tried statistics and probabilities. You're not a gambler, you're a trader. And so you got these numbers that you've already tested out that help you have confidence in your pair and in your strategy and in your trade management. Now, here I have several options that are all just random numbers. They are just setups to help you think and feel out what might suit you best numbers-wise. Most people take a nice chunk off their trade with the first take profit, and that's because many times price will take off, you know, in the level of your direction or your trade bias, only to retrace either to your entry or your stop loss. So traders usually want to secure profits at the first logical place. Now, with that said, I say that the first logical place shouldn't so much be a logical place as it would be a tested level that you have found to be profitable. How much money you take off the table and where you take it off, how often you take it, really is very personal. I usually do like a 70-20-10 pull on my current strategy, and those numbers are pulled at certain number of pips during the trade. It would be similar to this option 5 here, just with different percentages in the sense that I would run 70 and then 20 and then 10. So the amounts that are here, but I manage it here with a runner usually. With an exit signal, that would close when this runner was completed. I have found through testing that I make it an average of X number of pips on each trade. And that depends on which pair that I'm trading. I have one pair that I trade that I make an average of 80 pips per trade. And then I've got another one, that makes a little bit less than that. And then I've got a third pair that I tend to trade that usually moves a good bit more than that has a whole lot more volatility and momentum through the day. And therefore I can calculate where to take profits and where those levels are best to be able to hold on to my profits with the most probability. If I am trading with fibs, I usually also do option 5, but with these exact percentages, where I do a take profit 1, a take profit 2, and also then use a runner. Except there are 2 pairs where I saw through very thorough testing that I actually lost pips by letting runners go. So for those 2 pair, I always close a trade at take profit 3. So I have that be a set level on my fib and I exit the trade even if it looks like there's momentum, and I will look for another entry, but you're never going to get all tops and bottoms in a market. And so, that would be how I personally run my fibs. You're going to have trades that you wish you had stayed in because you would have hit the jackpot, but you're also going to have trades that you were so glad you pulled out at the exact second you did. And you're definitely going to have trades that had a great setup and followed all your rules, but the market just melted and you were way thankful that you had a stop loss in place. Otherwise, you could have totally blown your account. So this graphic really is just kind of giving you some ideas, again, that are very general. You don't have to copy them, but I just wanted to give you a basis of some things to consider when you're putting together a fully fleshed out strategy and you're considering the ways that you want to take profit or scale out. So in this first column here is just scaling out and taking profits. You really kind of just have 3 particular points or levels that you have set for take profit 1, take profit 2, and take profit 3, and you're closing the trade at take profit 3. So again, that would be kind of like if we, looked at the fibs and you decided at take profit 3, whenever price hits that point, that you're going to close the trade. So it's a preset level that when price hits that level, you close. And so that we have all of these in the first column that really kind of reflect that, using this first one, 80, 10, 10. And I actually traded those percentages for a while, 80, 10, 10, and then 70, 20, 10. And again, that's closer to what I do now, except that I leave a runner usually, unless I'm really just seeing structure, starting to print in a different direction or some of my signals of exit, but I usually leave a runner. But these are more of the percentages that I tend to trade with. And I've tried different strategies where I pulled 60, 20, and 20. And I kind of put some ideas here of how you would measure your stop loss, where once you take profit 1, you move your stop loss to break even, so that if price goes up your way and you have your, price retraces, that you're not going all the way back down and losing everything. If you're at take profit 1, that you're moving your stop loss. Here in this column, you have runners and scaling out at where you're setting that as take profit 3 instead of actually closing the trade out. And in option 4 here, you have take profit 1 being taking 50% off the table, take profit 2, maybe another 25% off the table. And as soon as you hit take profit 2, maybe you, in this example, set a trailing stop loss as soon as you hit take profit 2, and you're leaving 25% of your original trade on the table until your trading stop loss is hit or until until some other exit signal has been hit. Another option, again, just random numbers, is that you have a take profit 1. At that level, you move your stop loss to break even. Then you hit take profit 2. You take another 20% off the table. And at that point, you institute a trailing stop loss, say of 20 pips or 30 pips or 10 pips. You may want to give your trade room to retrace. Depends on what time frame you're trading, what pair you're trading, as to how big of a trailing stop loss you would set. But you set your trailing stop loss possibly, and you have a runner that's just going to go as long as your rules are being met and until price starts, say, breaking structure or reversing a certain number of pips, that you just let price keep running. And there's 20% on the table that's still running until, again, some signal tells you to exit or that trailing stop loss is hit. And now this third section is a section that was actually really cool. I traded this for about 1.5 years, and it's using the ATR, the average true range, to set your scale out points. Now the ATR is an indicator, and if you add that indicator to your chart, you will see that it gives you the average range of candles for a certain period of time. Now when I use the ATR, I don't like small ATRs. I actually like larger ATRs, so I would always do like an ATR of 20 or 30, and that means that you're looking at a period of, say, 30 candles, 20 candles. If it's a day, it's going to be, you're taking the average of the last 20 days of the movement. And let's say for the last 20 days, a candle moves 50 pips a day. Then when you enter the trade, you're going to look and it's going to tell you that it has an ATR of 50. And if you have that ATR, setting again for 20 days, then hey, for the last 20 days, this pair has had a candle that has moved an average of 50 pips. And so with this option 6 right here, if you have an ATR of 50, then for your take profit 1, it's going to be 1x the ATR. So at 50 pips, you take 60% off the table. And you would then move your stop loss to break even. Once price still continues to go in your way, you have a take profit 2 that is at 2 times the ATR. So that's at 100 pips. If your average range in the last 20 days, in our example, was 50 pips, now you're at 100 pips and you're taking another 20% off the table, and you're setting a runner with a trailing stop loss. And so that price keeps going up into your favor until it reverses and hits that trailing stop loss. And at that time, trade exits and you pull your remaining 20% off the table. And this is another option just like that. Take option 7, take profit 1, which is 1x ATR, and it takes 50% of your trade off, and then take profit 2, which is 2x your ATR, and you close the trade and take your additional 50%. Now, any of these numbers can be anything. You might be like, no, my trade rocks. I only want to take 30% off, on this take profit 1. I only want it to be 30%, and I want, or 10%. I mean, you can reverse these numbers and take 10%, and then have your 80% here. Again, that is very, very personal. And so I can't tell you that, but I just can say is that this is a part not to neglect, and you will dial that in. And especially if you find that you're not retaining your profits well, a tweak into how you're scaling out sometimes can really not only raise your win ratio, but it can also raise the amount of profits that you're keeping and what percentage your account is increasing over time as well.